Before we jump into the podcast today, I just wanted to let you guys know that getting a critical mass of investors and founders together is a powerful experience. In 2020, those face-to-face summits have disappeared. Fundraising has become harder for founders, and sourcing deal flow has become more difficult for investors in the Midwest. That's a problem that's not good for our youngest, newest, or most innovative businesses. So our friends at midwest.tech decided to put on a virtual summit to do something about it. Midwest.tech is an event that lasts 3 days with the purpose of connecting early stage founders across the Midwest with venture capitalists and angel investors focused on pre-seed, seed, and Series A funding. The event is 100% FREE for founders and features up to 12 30-minute meeting slots per day. Over 100 investors have already signed up. To apply, go to midwest.tech/connect. Again, that's midwest.tech/connect. And complete the application by August 7th to receive your invite to the can't miss event of 2020.
We made a cognizant decision that we're not going to have a website or any kind of online public presence about our fund because our investment committee is made up of only family members. So how our fund works is we're all our own LPs. It's literally 4 families. It's my aunt and uncle, my mom and dad, my brother and my sister-in-law, and me and my wife.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Woo!
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my co-host, Mr. Family Man himself, Eric Hornung.
I have 3 siblings. One of them just moved to Hong Kong. Rough timing. The other ones live in Cleveland with my mom and dad. And that's the family. That's the direct family. And I have one soon-to-be family member and friend of the podcast, Colleen.
And one relative who may be destined for sainthood.
That's a far-off family member. But yes, somewhere in Italy. I don't know. I really should get that story down better because you bring it up on the podcast a lot.
It just seems like something that I don't want to let go. Which one of your brothers moved to Hong Kong?
Brett did.
Really?
Mm-hmm.
Why?
He is on a project there for Accenture, and he'll be out there for 8 to 10 months working on this insure tech blockchain syndicate thing.
What did you find out?
I found out that an indirect relative died in the Civil War fighting for the North, but died in New York City in Trinity Church, which is the oldest church in New York. I've been by that. It's right by Wall Street. I've been to that church, to that graveyard before. Had no idea.
Same. It's where Alexander Hamilton is buried.
Yeah. How do you know that?
Because I love the musical Hamilton, and it's on Disney Plus right now, and I just watched it again.
Alexander Hamilton, I mean, he was the one who brought up the treasury. I mean, that was the original definition of FU money. We're just going to flood the market with fiat currency.
And Alexander Hamilton, if you haven't seen the musical, he truly lived his one life as well as he could have lived it.
Just like our friends at Ethos Wealth Management are trying to help their clients live their life the best way they can. And if you want to learn more about Ethos, go to upside.fm/ethos.
Well, Mr. Family Man, and speaking of our founding fathers, today we have finally completed our search to talk to a family fund. We are talking with Dave Sachse, the founder and managing partner of the Sachse Family Fund. And Eric, you've been looking to talk about family offices for quite some time.
How come family offices don't want to talk to us, Jay? How come?
I don't know, but we are super interested.
I feel like it's me.
You do seem a little thirsty to talk to family offices.
Well, I'm excited Dave decided to come on because family offices are historically, well, I mentioned FU money earlier. And the definition of real wealth is being able to say FU to people. I don't need you. I don't need to do this. I don't need to spend my time on that. I don't need to market. I don't care. That's how much money I have. And a lot of family offices kind of take that mantra, I feel like, where they are secretive, they're hidden, they don't want people to know what they're doing, they don't need to brand it, they don't need to I think you used the word thirsty. They don't need to be thirsty for things because they are quenched, Jay.
Last year when I went to Capital Camp, that time that I won't let you forget about that you didn't get to do, Nana Boo Boo.
It's great.
I met several guys. The whole thing was mostly guys. Several guys who run family offices, and they all had like very simple business cards, no websites, like, hey, we have money, we invest it, but we don't need you to tell anybody about it. We don't need you to find us. We'll find you.
Nothing is more powerful than a business card that is just your first name and a phone number.
Well, I'm excited to hear what comes out of this conversation. But Eric, unfortunately, I cannot join you for this conversation. I'm not sure if you did this on purpose or not, but I had conflict. And so it's just going to be you and Dave.
Just Dave and me hanging out, shooting the shit on family offices. We'll catch up with you on the back end, Jay.
If you guys have thoughts on this episode as you listen, you can tweet at us at UpsideFM or email us hello@upside.fm. And if you or someone you know runs a family office, we're interested in talking to more of people like you. So email us hello@upside.fm. We'd love to talk. And we'll get to that interview with Dave right after this. Hey listener, have you ever wanted to get a message in front of the Upside audience but weren't sure how to sponsor this show or weren't able to do a long-term sponsorship? Well, now you can just go to upside.fm/classifieds and let our audience know anything that's going on in your world, whether it's an event, an application, a special coupon or deal, or just letting them know who you are, what your company does. All you have to do is go to upside.fm/classifieds and you can place an ad on this show. That's upside.fm/classifieds.
Dave, welcome to the show.
Thanks for having me, Eric.
I want to start with how you got into family office investing.
Yeah, as far as family office investing, I mean, my family started a family office when my parents sold a manufacturing company in 2012. I was more just very fortunate with the hand I was dealt in life to all of a sudden find myself in my own family office later in life here. So that's kind of how I organically started working out of my own family office.
Did you always know that you were going to have some substantial wealth growing up, or was this a kind of sprung on you thing?
Definitely didn't always know, but I wouldn't say it was sprung up on us per se, but I mean, my parents are always long-term thinkers, and I was raised in an environment where we understand the value of a dollar. In addition to, if I got $10 in a birthday card, my parents would tell me to figure out, save 11 of it. So all of a sudden, that was kind of the mentality that I grew up in. So I wouldn't say it was a surprise, but I didn't say, I was expecting it either.
So walk me through what that looks like. Your family finds liquidity and they decide, oh, we should set up a family office. How does that even happen? And how involved were you in that process?
Yeah, no, good question. I think this varies from family office to family office. I mean, we're a very modest or smaller family office where it's really only family, and then we have a few admin and additional staff. I mean, there's other families' offices that will hire dozens of staff to manage different asset classes and whatnot. But realistically, I mean, after my parents sold the company, both my father and mother are very community oriented, as well as just helping other businesses, whether large, but especially small and medium sized. And so my father set up a consulting business out of an office where family worked that then became the family office. And so he helped consult and work with, young entrepreneurs and SMB companies and older entrepreneurs. And then my brother and I just started doing different ventures out of the office as well.
And how did you get up to speed on what this looks like and what you could and couldn't do?
As far as could and couldn't do, what do you mean by that?
I don't know what I mean by that, to be honest.
Yeah, I get where you're going. So the interesting thing with family office, and especially if you're investing out of a family office, is you're pretty fortunate because you get to make your own rules. It's much different if you raise a formal VC fund because you have an investment period, you have a term period. You have to make certain investments at a certain rate. In family office, you can be patient capital. You can make 10 investments in a month or 0. So you don't have to deploy like VCs do necessarily. Is that kind of what you were saying?
Yeah, I think so. So as I understand a family office, you mentioned the different types of assets that you can invest in. And obviously we're interested here on the podcast about venture capital, but what percentage of venture capital, and it can be in vague terms, What percentage of your portfolio is allocated to a venture capital investment versus a public investment versus a private equity investment? How much do you think about funds versus direct investments? And you can kind of talk about your specific family office or the family offices that you interact with in general here.
Yeah, so I think there's a lot of different flavors depending on the size of the family office, on how much they're allocating towards certain asset classes, and also with the expertise and their background. But just talking like early stage venture investing here for a moment, a lot of the financial advisors that I've spoken with that work with family offices, they're typically suggesting anywhere from 5 to 10% of liquidity can be kind of focused on that. But again, that varies. That's more just an average, I would say. But yeah, I mean, that's kind of what I've seen is the allocation. And for us, I mean, we're similar. We might be slightly higher here with also the market correction and kind of downturn occurring here. But yeah, no, it's a blast. We're having a lot of fun doing it. We both do direct investments as well as venture funds. The reason we invest in other venture funds, for many reasons, it's diversification of investment. It's to augment our team. I'm not afraid to say I don't know, and I say that often. So I'll ask a lot of these smart full-time VCs that we're partnered with. Yeah, it's also for deal flow as well, and just to try to make more bridges, especially in the Midwest when there's not a lot of capital as there are in some of the other key cities, Boston, New York, San Francisco, places like that.
So when you're looking at a fund as an LP, what are things that stick out to you as saying we should allocate capital here?
Yeah, so we look at a lot of different things. Me being new, kind of the investor side, I was pretty naive on emerging managers versus proven managers, and I didn't necessarily look at that as much. And I know a lot of institutions and endowments look at the later stage managers. I actually kind of took the opposite approach. We looked at more of the emerging, or if they're in like their first 1, 2, or third fund. And we looked at certain geos that we wanted to have a presence in, or at least have boots on the ground that had a formal partnership. But we also looked at style and strategy. So for us, like our family is a family office of entrepreneurs, and we're operators. And how I grew up is like no work is beneath you. And so those are the type of operators that we kind of align with, and same thing on the investment side. So the investors that we align with are more operators. Those are the ones who truly have empathy and understanding of kind of the founder journey and how it's a journey of peaks and valleys, and often a lot more valleys than peaks. People just publicly see the peaks. So they think that's what a lot of, entrepreneurship and early stage investing can be. But 98 to 99% of the time, it's a grind. So it's awesome having operators as investors on your side, knowing, hey, not only are we going to support you financially, but also operationally. And we're going to think about, getting strategic capital to work for you and not just idle capital that's along for the ride.
Is it ever weird because you make direct investments as well as invest in venture companies that you kind of are competing for deal flow with them, or does that not ever happen?
I wouldn't say that's never happened, but I don't view it that way. So I'm not in the venture game here to count how many unicorns we have or to get in the latest consumer technology or anything like that. So I don't necessarily have sharp elbows. I'm more about really trying to invest in smart entrepreneurs, but also drive community development and creating modern jobs in some of the areas of the country that really need it. And they really need more capital to support these entrepreneurs, especially at a time now where, it's becoming a lot more capable to build technologies anywhere and to scale those technologies. So the capital needs to catch up to those areas as well.
How do you think about branding in the family office space? I feel like a lot of times people just say family office, and sometimes that means we're one family and one person doing one thing, or we're a multifamily office, or we are White Rock Capital and it's a family office, but no one would know that's a family office because they're coming at it from such a fun style investment. Like, just talk about branding in general and the decisions you guys have made on how to and when to brand.
That's a great question. So I've seen kind of branding all over the board. There's kind of two thoughts to this. There's like the very public brand, and oftentimes, it might not even have, it might either have the family's name or not have the family's name in it. Sometimes that depends on who's actually working for that entity. Are there any family members, or is it all non-family members? But then there's kind of the other vein where it's like you can't find any information about it, and it's only kind of word of mouth. I'm kind of in that camp. I learned why my IC or investment committee thought that way. So we made a cognizant decision that we're not going to have a website or any kind of online public presence about our fund, because our investment committee is made up of only family members. So how our fund works is we're all our own LPs. It's literally 4 families. It's my aunt and uncle, my mom and dad, my brother and my sister-in-law, and me and my wife. So I have a fiduciary responsibility to them. And there's people on the committee that didn't want to be solicited for 6-figure checks on, ideas that were written on a napkin the night before, and putting them in tough situations with friends, family, acquaintances, neighbors, stuff like that. So we make the cognizant decision to not have a public presence for that reason, largely for that reason. But I will say, we do decks, and we share decks with VCs and founders and other partners, accelerators and stuff. But yeah, I haven't really put any branding behind it. And now that I'm 3 years into this journey, I've realized that my deck looks like I made it in Microsoft Paint. So I'm starting to invest a little in some design, but we still don't technically have like logo and stuff, and it's just the Sachse Family Fund.
Have you used beautiful.ai by any chance?
I have not. No, what is that?
It's great. It's like high quality decks for people in a hurry.
I will check that out. Thank you. Just for the record, I did not make my deck in Microsoft Paint.
It's okay if you did.
Some slides look like it. So,
what are some of there's the obvious downsides of not having a brand and the obvious upsides, it sounds like, of not having a brand. What are some of your frustrations with not having a reputation in the marketplace, or only having a incognito reputation in the marketplace?
I don't know if they're frustrations as more as they're challenges per se. But yeah, credibility, people taking you serious or even taking a meeting with you. I typically often have to share my deck ahead of time if I'm not getting a warm intro. But, yeah, I mean, the big elephant in the room is most traditional VCs don't like family offices doing direct investing themselves. And if you know that, it gives you a leg up than most family offices. But I mean, then there's many reasons for them to feel that, because family offices treat it like private equity, or they play Shark Tank and try to take too much equity up front. They'll put silly terms in to deter investors downstream to not wanting to touch the deal. So then all of a sudden you're shooting, the founder in the foot, even though they think it's a successful milestone, but really they just walked into a trap because nobody else is going to invest in them. So, I get a lot of the reasons why VCs have that mentality towards family offices. So that's always a challenge working around that. I usually counter people with that because I'm often overlooked and quite an underdog, and I'm okay with that role, and that doesn't bother me. But the thing that's pretty interesting, Eric, is being in the family office position that does direct investments as well as fund investments. I see a lot of different decks, not just on the startup side. So on the fund side, that has accelerated my learning over the last 3 years, is seeing how different funds are structured and how different strategy. Now, I treat all that information confidential and only for our internal use. But yeah, it's accelerated my learning immensely. So if capital is equal, I'm starting to understand how VCs compete. Yeah, and I think that gives me a leg up. So, the one thing I think that VCs will do with family offices is they target them to be LPs, and I get that. But, I think often if they're not one of the big name family offices, they definitely get overlooked and underestimated for sure when it comes to venture investing.
Do you think that makes you a better co-investor with VCs, or a better early stage investor for those later stage VCs? I guess that's one question. And then a second question would be coming off of that. When you guys are making direct investments, are you eating the whole round, or are you taking a portion and then having co-investors?
So, I think we're a benefit for both those, to co-invest in addition to do it directly ourselves. And what I mean by that is kind of what I said before. We don't have sharp elbows. And literally, we have a list of philosophies internally for how our fund operates. One of those philosophies is if you take care of the founder and you take care of their customers and their team, good things will happen. And that might mean not making the best decision for you as an investor. So I'll give you an example. Recently have a company going through Series A, and we were in early, wanted to act on our pro rata, and part of our strategy is acting on our pro rata until a Series A. However, it was way oversubscribed, I think like by 2 or 3x. There was a lot of strategic money that was trying to get in to come further. So it's a no-brainer for us then, even though it's not, I mean, it's painful because that's part of our strategy to act on our pro rata, but we waived it because that's what's best for the startup. And again, because our fiduciary responsibility is to the family, we're not always playing we need to make our investment this quarter. We need to get that 5% or 10% allocation to make sure that this could be a return that returns the fund. So we're not playing that same game. So we do have an advantage that way where we can be much more patient and opportunistic capital.
What are the other philosophies that exist in the fund that you can share?
I mean, so the other philosophies, family first. That sounds corny, but working with family is very challenging and very rewarding at the same time. But putting in governance and making sure that, there's a process and a structure, especially if you have strong opinioned entrepreneurs in your family, is really critical, because otherwise, all of a sudden holidays could really, really suck.
Yeah. How do you think about that? Because you're investing in tech and these high growth businesses, and your family comes from a manufacturing background. Is there ever any rub there?
What do you mean by rub?
Maybe a misunderstanding or misapplication of prior experiences or business models on new businesses or business models?
I mean, it is a little challenging because you go from the widget mentality of build it and it's done. You could create a new version or a different version that might cannibalize it. But, to software where you're always building and you're always upgrading it. It's never done. It's always just constantly being updated. So like that mentality is a huge mentality shift. But, the other things too, you just look at unit economics can be very, very attractive. So, B2B SaaS companies having gross margin of 70 to 90%. I mean, if manufacturers had that, they'd be salivating. So yeah, there's some pros and cons that we work through, but I do have experience trying to do a high growth startup out of Wisconsin and Chicago out of 2013 timeframe. So I have some experience kind of jumping in the fire for venture backed startups and understanding the pace you need to develop software to be successful. So I have some of that background. And then, as corny as it might sound, I've been learning a lot on Twitter over the last decade. I mean, I follow probably around 2,000 people, and I would say 80% of that is in the tech startup space. Now, a lot of it can be noise and stuff, but there is a lot of useful input and valuable data there as well.
Do you have any pro tips for following people on Twitter?
Pro tips. I would not consider myself a pro Twitter. I usually will follow anybody that is just tweeting out relevant content that I find really interesting. So if that's tech, VC, sports, particularly NBA or Bucks, I mean, I usually give them a follow. But it is, I mean, it's good to look at lists too, because your Twitter feed, especially with the updated algorithms, it can get a little less useful and more noise if you don't have control of that.
Is Giannis the best player in the NBA?
No question. No question.
You're going to fire up some people.
No, I mean, whoever those people are, send them my way and we can have a debate. But he was on pace for the best player efficiency rating of all time. He averaged pretty much 30 and 12 this year by only playing 30 minutes. Harden needed like 45 minutes for that. So, and I know LeBron had a good story, but the stats don't say it was that good of a story compared to Giannis's.
Let's flip this back to family offices before we go down a sports or rabbit hole. How much collaboration is there in between family offices? We see these family office associations. Are those real things? Do you have like a cohort of family offices that are on Slacks that all talk to each other like VCs do? Or is this a completely archipelago type setup?
I do see a lot of family offices collaborating, whether it's through kind of a formal family office group, which there are a lot of those organizations out there. And I think some of them, do a good job as far as creating structure in a family office or legacy planning, financial planning to future generations, stuff like that. It's just not my style or my flavor per se. So the collaboration or interaction that we've done with other family offices is has been more local in Wisconsin, although I've started to get connected to more national now just due to VC. But yeah, oftentimes they'll talk to each other because they want to be kind of private with some of these informations, and some of the challenges are just unique challenges that not a lot have, so that they try to get a sounding board of this because not a lot of people are in similar situations. So yeah, for example, when I started this venture fund out of my family office, I slowly but surely got connected to other either family members of family offices or representatives of family offices that would have a meeting with me and pretty much undress me with all these questions about how did you start a family venture fund? How do you do it out of your family office? The governance, if it's not unanimous. How do you get national vetted deal flow? What do you analyze on these companies that are only 12 months old? Like, there's not much data and stuff. How do you actually do due diligence on that? What terms do you care about on a term sheet? Is this control terms, economic terms? And especially if you're investing early, what happens to the terms later on? So all these questions, do you do one pile of money? Do you do multiple pile of monies? So all these questions. So instead of me having all these kind of one-off conversations with family offices, I looked at this as an opportunity to bring others along kind of our journey. So I set up a formal syndicate, if you will, that's actually called Family VC, as corny as it is. But I do treat all these members as if they're extended family. And it's really a group about collaborating and just learning around VC. And we do that in a variety of different ways. We do that through essentially deals, data, and discussions. So I share at least 30 vetted deals a year, and also showing some of our investment activity so they can see kind of as we go, things that we do well and things that we learned to do better next time. So, we're kind of opening up the hood of our family office venture fund to make others comfortable and see, hey, there are others doing this. And yeah, so we do that with deals, and then data. I have an educational newsletter. I'm just a data nut. So if I see a family office report on, families allocating more to VC or this asset class or different strategies, I'll share that with the group in our newsletter, and as well as national and local VC news. And then we have discussions or in-person events when there's not a pandemic occurring. We typically bring VCs, whether local or national, in, and then we just have kind of open dialogue conversation. It's not a pitch environment. This isn't a fancy wine and dine dinner over 7-course dinner or anything like that. This is more like cookout, chat, family style, more, hey, no question's a dumb question. This is kind of the safe tree, if you will. So that's kind of the environment I set up. And yeah, the group actually has been phenomenal so far. I mean, we have over 40 members, individuals in our group that represent 8 family offices, as well as a couple corporate venture groups. Yeah, it's been a great group. I mean, they've already co-invested with us over 1.5 million, and we just started it in July. And again, we're doing early, more seed stage investing to where the checks are our average check is $200K, for example. So it's more early stage, smaller checks.
And when you're doing this fund inside a family office, one of the things we hear about family offices is that they have patient capital, they can deploy it in whatever structure they want. But when you're doing a fund inside a family office, do you then bring the VC style terms and length of fund, and you have that 3 to 5 year deployment window and you want to exit in 10? Is it the same kind of structure within a family office, or is it hybrid or different, or how's that look?
Yeah, I mean, I think it varies for all family offices, quite frankly. But for what we did, I think, and what I've seen is the best family offices operate as if they're a fund sending money to people they don't know and have a fiduciary responsibility. So, and what I mean by that is, yeah, having a 10-year outlook and having a thesis. And, I'll tell you, I wildly underestimated how much work doing a venture fund well is. And you've probably seen my other brand, Midwest Perks. That's a consulting company where I help early stage tech companies with sales strategy and fundraising strategy. And I started that at the same time I was trying to convince my family office to do a venture fund. And slowly but surely got them on board. But then I just wildly underestimated how much work it is. And it's definitely a full-time job, and we're understaffed. But I do VC full-time. And I think the best family offices do it full-time and treat it like it's a real fund. The reason is, otherwise you can quickly get away from your thesis or your strategy. And then when you start spraying, and then you do the spray and pray type thing. Then you're almost like doing an index model, and you don't have a clear path to what is our return profile that we're trying to get. So, I mean, everything that we look at, we consciously evaluate it. Can it be a 10x opportunity? And granted, we're early stage, so pre-seed to that late seed. So anything that we look at, can this be a scalable 10x return? And I think, the families that operate with a true thesis and, stay to that thesis at least 80 to 90% of the time, I think are the best ones that I've seen.
One of the things we've heard on the podcast before is that angel groups tend to move very slow, whereas VCs tend to move relatively quick. When I think about patient capital, I think that there's this longer term horizon. Now, you guys have a bit of a mitigation strategy there where you have that 10-year horizon, but there's no such thing as a patient founder when they're fundraising, right? They want it quickly. So how do you guys think about speed to close versus the fact that you have a variety of patient capital?
So that's a great point. I mean, speed to close is important because that's also how you compete in VC. But granted, the really intense speed in the Silicon Valleys, the New Yorks, the Boston, I mean, we're not going after those deals. So we don't need to act in days or a week type thing. But, we do have a process where at minimum it's a couple weeks. So at least 2 weeks, because we have certain documentation internally, and then we do investment memos that we circulate with our investment committee that then reviews it, and then we meet on it. So we can act pretty nimbly, during a pandemic when you have operating companies and you're trying to keep people employed, operating companies outside of our portfolio, which we also have 15 portfolio companies that, you're checking in on. We can typically act in a few weeks. This is a little bit of a challenging time because you're herding cats because everybody's putting out fires. But yeah, no, I mean, that's pretty much how we operate.
What am I not asking about family offices, family office investing, governance, getting into family offices that I should be asking?
Well, I think the speed, I think you're right, Eric, with, thinking of founders that, they need to be careful with who they're engaging for fundraising. Because I know, a lot of people do make fun of or steer clear of angel groups because they can take a long time. However, I do think there's a ton of value from some angel groups as long as you understand the process. And I think that's the biggest thing that founders should understand with any investor they're going to, especially family offices, is asking about the process. And like, just as much as they're questioning you, you should question them as a founder. Because some processes, hey, they're a minimum of 8 weeks. Okay, well, we're on a timeline where we're going to close in 3 weeks. So that's probably not going to work. But, and how we operate, anytime we know we're not going to invest or it's going to be a no, I try to communicate instantly. Even if that's verbally on the call, that's just so they know where we stand. Because I think the worst thing that happens, especially if there's, a downturn in the economy, is investors kind of, dragging things out and or not being just direct and even ghosting founders. I mean, that's awful. And that's another value that we have. We don't ghost intentionally. We don't try to not ghost anybody, whether it's another investor, a founder, a rep at an accelerator, or other partner. We try not to ghost anybody. So I think it's important that you understand that when you're approaching family offices, so you don't get in a quagmire where you think you have some capital, because you don't have the capital until it's in the bank account.
And I do have one last question. You mentioned earlier on in this interview that you had a thesis around specific geographies. You've also mentioned that you're specifically interested in Wisconsin. Your second company is called Midwest Perks. So where do you find yourself most interested in investing?
I mean, from a philanthropic standpoint and just a need standpoint, yeah, the Midwest, because there's a lack of capital. But due to our core focus, even though I am very philanthropic and community driven, because I do have a fiduciary responsibility to my family members, we go for the best opportunity, wherever that may be. It just so happens that because we're trying to do a 10x type return, we're looking at, valuations that are much lower. That tends to be in some of these areas where capital isn't as flushed and it's not as prevalent to raise at higher valuations. So that sometimes puts us in the Midwest or Greater Rocky area where we're finding just some better valuations, companies that have better valuations with a lot more traction. And it's just a better deal than on the coast if they're just going into pilots and, they're already at a 15 million pre or something like that. To do 10x and if you're investing at stages like that all the time, The math will probably not end up working out well for you.
If people want to know more about you or your family office, I guess, where should they go?
Yeah, I mean, the best spot is probably to reach out to me on Twitter, or people can hit me up via email. It's a pretty simple email, just dave.sachse, last name SACHSE @gmail. Otherwise, just find me on Twitter, shoot me a DM, and I'll shoot you my email, and we can connect if it makes sense.
All right, Eric, you just spoke with Dave Sachse of the Sachse Family Fund. Did you figure out why family funds don't want to talk to us? Is it you?
It's not me, thank God. It is incentive structures. It is the fact that they have enough money to not need to do a lot of the things we see funds doing. They have their own capital, their own balance sheet, and a lot of people refer to this as like patient capital. They don't have to do anything with it. They have to support their lifestyle, and the money that they have is to be invested in ways that they find interesting or compelling.
Talk to me a little bit more about investing off balance sheet. We talked about this a little bit in our conversation with Jason Illian of Coke. I'd love to hear more about that and what that means to you, because my finance brain isn't like your finance brain, and I don't know what that means.
So I think the best way to think about it is comparing like a fund and a family office. For a family office, let's say you have $10 million in the bank. You don't need all of that to live. So you have a significant chunk of money that is an investable asset. And some of it you're going to put in things that are very conservative. Now, that might have traditionally gone in like a bond portfolio. Right now, bonds are yielding like 0% pretty much. So maybe not the best place to protect against inflation. That's irrelevant to this conversation. But a portion of that, those investable assets, are going to be used potentially, depending on the family office, on alternative assets, which might include things like private equity or venture capital, which might be invested in funds or directly invested in individual companies. And because of that, there is no time frame. Like, this money is going to be planned for, and it is going to be invested over your entire life. And you may run out of it, or you may give it away, or you may have some estate plan at the end. It might go to your kids, or it might go into a trust. And there's all this stuff that can happen to it. But it's not like you have to give that money back to anyone at a defined period of time. So with a fund, you have a very specific mandate that 10 years from the day you start the fund, you need to be returning money to your investors, which completely aligns incentives differently. And for a fund, that means you have to make as much noise as you can to get the best deal flow you can, to get the best deals you can as early as possible. So that way you make sure that you're returning to your investors, because your goal isn't to beat inflation. Your goal is to beat every other potential fund out there.
So it sounds like running a family office comes with a lot less pressure.
Yeah, being rich is just always easier.
How easy would it be to screw up a family fund?
Well, there's a really cool stat. The Vanderbilt family met in there were like 200 and some heirs of the Vanderbilt family. And I think they met in like 1997 all together. And there wasn't a single millionaire in the group. So people tend to lose money over generations. Within the first generation, though, it just depends on the market and how you allocate capital. It's very variable. One of the things I was excited about with Dave coming on is he is super interested in venture capital coming out of the family office perspective, but also interested in it in terms of funds and fund investing. I think he has a kind of wealth of knowledge about that intersection between family offices and venture capital. He has a ton of connections with Midwest perks. I find that he's a very thoughtful person in general and super well respected by founders from what I've heard around the Midwest. So Dave is definitely someone that I'm excited we connected with on the podcast. I think he thinks about things critically, and I really appreciate him coming on and being one of the few people who's willing to talk about family offices publicly.
Well, Eric, I hope you and I, through the course of this podcast, can amass an FU wealth of knowledge.
An FU wealth of knowledge? I'd also take an FU wealth of money if you want, Jay. We can do both.
Well, we'd love to hear your thoughts on this episode, dear listener. You can tweet at us at UpsideFM or email us hello@upside.fm. And again, we're interested in talking with more family offices. So if that's you or if that's someone you know, connect us over email hello@upside.fm. And we'll talk to you next week.
That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter @UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep on rhyming, find a way and get it.